Welcome to Scope's Portfolio Manager Conference. My name is Manqing Sun, fund analyst from Scope Analysis and the moderator for today's webinar. Today, we will tap into ESG investment in the global portfolio context. Taking advantage of the gap between expectations and fundamentals is a time-honored investment strategy. How can investors identify tomorrow's winners among global companies that all claims to incorporate sustainability factors? For this, I'm very pleased to be joined by our guest speaker, Johan Swahn, lead portfolio manager of Nordea Global Stars Equity Fund. He's joining us on the line today from Stockholm. Welcome, Johan. Would you kindly give us a snapshot of ESG investment landscape? US and Europe, as we know, are relatively well established in ESG investments. We see majority of the exposure of your portfolio allocates to those regions. How about companies in other regions? Do you see a potential of great, for example, an ESG story there?
Yeah, I mean, I think from an ESG perspective, when we talk to companies, Europe and particularly, I guess, Northern Europe and Scandinavia has been ahead of the pack and for a long time. In North America, we're seeing a big change in recent years when we launched the Global Stars funds, which is about 5 years ago now. The interest we got from American corporates or companies in ESG issues or talking about the ESG issues was virtually zero, and now it's top of everybody's agenda. So it's been a big shift, and it's very encouraging to see that a lot of companies really are taking these issues seriously now and starting to change. So I would say Europe in the lead, US is waking up quickly, and we're seeing a similar development in Asia, but perhaps even a little bit further behind in terms of how they focus on ESG matters. So that's kind of what's going on the corporate side, and on the investment side, it's quite clear to us that investors are. I mean, this is clearly the main focus area for investors, and that goes across the globe, Europe, US, and Asia, for sure.
Okay, so building up a global portfolio requires a strong team, resource, and country affinities. Could you introduce to us about your crew? How many analysts are there to support this strategy? What are the roles and relevant background? What does the in-house collaboration look like within the research network at Nordea?
Right, so I actually have a slide. See if we can pull that up here. So this is how my organization looks like from my perspective or my daily work. So we run global and North American mandates, stars mandates together. Me and my partner, who is my co-manager, and I co-manage his fund in North America. So. But in total, we have a very good support from research team, both on the investment side and the ESG side. And I think what we are trying to do at Nordea is to integrate these two things into one process. And the way we do that is through a matrix system, if you will. So we have our ESG specialists are embedded into our investment teams as a support function to the analysts and PMs. To figure out the more complex parts of the ESG questions. So the setup we have today is we have 6 analysts who are directly supporting the global and North American strategies, who are specializing in various the different sectors. So we have industrials, materials guys, 2 TMT guys, healthcare guy, financials, and so forth. And then we have one ESG specialist embedded into the team who helps and supports us to get that ESG research process perfect across the sectors. And then, of course, in Nordea, we have other teams that are working on European and emerging market mandates, and the whole sort of organization works on the same research platform. So for me as a global PM, that's very useful, because then I can use the work that has been done in these teams to source ideas and get help with research on these regions. So in total, we have something like, I think today, 17 ESG specialists, and the investment team, including everything, is around 25, 30 people, something like that.
Okay. So tell us about Nordea's STAR concept for our audience who are not familiar with these product lines. The STAR funds only invest in best-in-class companies, and unsustainable companies in industries will not pass your ESG hurdle. How do you define your universe, and what are the typical unsustainable industries that you suggest? Could you give us some examples?
Sure. First of all, we don't really define our universe in the sense that we screen for certain characteristics or anything like that, but instead we do in-depth research on all the companies that we invest in. We think it's, just extremely important to have this capacity and capabilities in-house so that we are able to take responsibility for the investments that we make, not just from a investment performance perspective, but also from an ESG perspective, that our clients should be able to sleep well at night knowing that we only invest in sustainable companies. And we think that can only be achieved through in-depth research on the individual companies, because this tends to be quite complicated matters, and every story and every stock is really unique. So with all the stocks that go into our portfolio, we can explain in depth why we hold them and why we think they are good, sustainable companies. The STARS concept is something that we have been working with at Nordea for a little bit more than a decade. The first fund that was launched was called Emerging Stars, launched a little bit more than 10 years ago. And it's really the three pillars that we try to combine. And the first one is we want to use our expertise in ESG. We spend a lot of resources and capacity on ESG research, and so we want to use that to try and generate some alpha and get some alpha out of that process. So that's the first pillar, to beat the benchmark and to be able to compete with pretty much any other product in that class in terms of risk-adjusted returns, but with a sustainable footprint. Then the second pillar is to invest in sustainable companies and to make sure that our portfolio has a good sustainable profile, and that is done, like I said earlier, through in-depth research, and ultimately we have an in-house rating system where we only invest in companies that are passing our hurdles for sustainability. And then the third pillar, as we say, is our engagement process, where we use our expertise in discussions with companies across the world to try and make them improve how they manage their ESG risks and manage their ESG profiles, and in some cases change the way they operate and report on these issues. So that's really the three pillars that we have in that STARS concept.
So the cornerstone of your global STAR equity strategy is based on a core satellite approach. So could you explain what that is and give us some examples?
Sure, I can try my best. So if you're a portfolio manager, right, if you want to make more money, you have to either take more risk or you have to take better risk. And what we try to do is to take better risk. So the core satellite approach is really a function of how we want to take risk. We want to focus our risk on a few high conviction positions where we really have a belief that we can take a different view from what the market does and make money in that way. At the same time, we want to diversify risks in the portfolio that we're not so keen on taking or that we don't particularly like. And we think we found a quite an elegant solution for doing this, and at the same time generate alpha across the whole portfolio. And the way we do it is to have this core satellite approach, or a two bucket approach to constructing our portfolio. Where the first bucket is what we call our expectations gap bucket. This is positions where we take a differentiated view from what the market is pricing in, and trying to exploit mispricings in the market. This is typically a little bit shorter to medium term type positions. So we typically would say 1 to 3 years for such an investment case to play out. And this is resource intensive. We put a lot of efforts into finding and managing these positions, and oftentimes they generate, or the idea is that they generate outsized returns, and particularly if you time adjust it. And then the second bucket, or the core of the portfolio, is really where we do our long-term investments. And the idea here is that long-term winners, or long-term or stocks that perform really well in the long term, we believe that they tend to have two very typical characteristics. The first is that they have what we call moat, which is really some sort of sustainable competitive advantage that allows the company to generate excess return on investment, which compounds over time, allowing it to grow faster or distribute more cash to shareholders and so forth. So that's a really, really important trait of companies, we think. And the second thing is, we believe that this type of companies tend to have some sort of tailwind, some sort of factor that allows them to grow faster, or generate better returns over time. And this can be either their position in the supply chain, or some sort of macro factor that drives growth for them. So you can think about something like Amazon, for example, which is clearly a beneficiary of the increased penetration of e-commerce. You can think about MasterCard, who is a beneficiary of increased penetration of digital payments globally, and so forth and so forth. So we believe that if we can identify companies that have both these traits, the moat and the tailwind, we think we can identify long-term winners that generate good risk-adjusted returns over time. And we can use this approach to also diversify our portfolio by taking many smaller positions across sectors and geographies in this type of companies, and in that sense build the core of our portfolio. And then we combine these two, we think we get a very interesting risk return profile for the whole portfolio, really.
So what is the ratio between the high expectation gap stocks and the moat and tailwind stocks? How do you come to this proportion?
Yeah, so what we typically say is we want about a third of our portfolio in these expectations gap stocks. And we like to have quite few of them. So let's say 10 or maybe up to a dozen different positions in that part of the portfolio. So fairly large and fairly high risk positions. And why a third? Well, it's really a function of the desired risk level of the portfolio, but it's also a matter of our belief that capacity constraints play in, that there's really so many stocks that one PM or one analyst can handle, where we have a different view from the market and be right. And I think a problem that many fund managers run into is they run too concentrated portfolios with too many high risk positions. So let's say you have 30 stocks in your portfolio. Of course, your highest conviction stock is likely to work, but your 25th or your 26th best idea of the day, is that as good quality? So we think that if we can focus on a few positions and actually get them right, we get a very good contribution to performance from that. And then we use the remaining 2/3 of the portfolio and allocate that to this more sort of long-term winner ideas that for us requires a little bit less work on a daily basis and where the positions sort of are left alone to grow and compound over time.
Mm-hmm. So if you click on the peer group on our Scopes Explorer, there are easily more than 100 funds in your peer group of equity, sustainable, ethic. What do you think makes this fund unique or stand out compared to your peers?
Well, I mean, first of all, I think for any fund to be attractive, you need to generate good risk-adjusted returns, and I think we have that, and I think people recognize that when they look at the numbers. But perhaps more importantly, I would say that Nordea is really an ESG pioneer, and we've been doing this for a long time. And if you invest in global stars, you get a very well researched, you get exposure to very well researched sustainable companies where the investor knows that we have gone the extra mile to really dive deep into the issues of the company and the ESG profile of the company to make sure we have a sustainable portfolio. And I think that's I mean, if you look across the market, there are all sorts of ESG products, and some of them are sort of quant based, and some of them are screening based or whatever. We don't believe in that concept. We think you have to go really in depth into the companies to make sure you have a sustainable profile in what you invest in.
So you mentioned the performance, of course. Let's talk about performance. And the fund achieves a strong performance, beating the peer group average throughout 1-3 year of investment horizons. Where did the majority of active performance come from over the last years? What are the main alpha sources?
So the way we construct the portfolio, we want a majority of our active risk to come from selection rather than different factors. So we run a core portfolio, right? When I look at the sort of return attributions, it tends to be about 2/3 of the active performance comes from selection effects rather than factors. So that's supposed to be the main contributor to performance, and so far it has been. Interestingly, or at least from my perspective, we also look, of course, at the performance attribution from what we call our expectations gap bucket and our moat and tailwind bucket, and I have a slide on that here, where you can see that we can't really see, but really over time we have similar contributions from both buckets in terms of excess returns or basis points of excess returns, if you will. And if you remember then that the moat and tailwind bucket is about twice the size of the expectations gap bucket, you can sort of assume then that the returns are slightly higher on a capital basis in the expectations gap bucket. But you can also see from this slide that it's more volatile, and that has to do with us taking more risk or taking a little bit riskier positions in these stocks, whereas the moat and tailwind return is more sort of evenly distributed. But then the other thing you can see is that, for example, last year, in the first half of the year, we had really negative return from our expectations gap bucket, which was very much due to the pandemic hitting us a little bit unexpectedly. But then we had better return from the high quality type stocks we hold in the moat and tailwind bucket. And then in the second half of the year, we got very good returns in our expectations gap bucket and less so in the moat and tailwind bucket. So these two different styles tend to work well in tandem as well to get that more sort of nice and even return profile that we like.
So, due to the nature of this strategy, do you see any risk of sector clustering? How do you control such risk?
Sorry, I didn't catch that.
So do you see any risk of sector clustering? How do you control such risk?
So, did you say saturation?
Saturation. The sector clustering.
Sector clustering. Yeah, I mean, what we are noticing in the ESG space is that some very popular stocks tend to get very expensive. You can think about renewable energy stocks, for example, or Tesla, which is a typical ESG stock, I guess. These thematic stocks tend to become very expensive. And of course, that's good if you're already a holder, but it becomes a problem for us once these stocks become too expensive. They're difficult to hold on a fundamental basis in the portfolio. I think this is transitory in nature, and I think investors like ourselves need to broaden our perspective on what's good ESG and what is a sustainable stock and so on. And it's not just about having exposure to Tesla or something similar. It's a much broader concept, even if we have some of these sort of more conceptual stocks in the portfolio as well, that contribute to a greener world. So yes, I mean, like always in investing, there are high tides and low tides, and sometimes certain assets become a little bit too pricey, and then you have to take that into account when you make your investments.
Okay, so what do you think about the overall risk for the portfolio? Are there any additional measures taken to protect downside and control the volatility?
Yeah, I mean, again, I think taking risk is really a core competence of a portfolio manager. That's really what we do. So I see myself as a taker of risk, right? So how do we manage risks? Well, the first line of defense is really to have solid research on what you invest in, and to have a well-defined and solid investment style. And for us, these moat and tailwind stocks that I've talked about are typically a little bit lower type risk stocks with high quality, and with our expectations gap bucket, we try to go really in depth and do our homework and try to do as much as we can to raise our conviction that we are right in our views on the stocks. Then I guess the second line of defense is really myself as a portfolio manager. I need to construct a portfolio that has well balanced risks and make sure we don't have unintended risks in the portfolio, and all of these things that comes with constructing an optimal portfolio from a risk reward perspective. And then the third line, of course, is we have risk control measures in place. We have a risk team. We get daily risk reports. We have risk reviews with the risk team on a quarterly basis and on an ad hoc basis, and so forth. So I think the risks in the portfolio or in the fund is really well under control and a key part of our process, really.
Mm-hmm. So despite the disruption in the market, many say the pandemic has been a catalyst that accelerated ESG as investment concept. So our question is, in light of the impact of this pandemic on the portfolio, did you see any new buying opportunities arises in the crisis, or any business model, for example, become obsolete or distressed? Did this have implication on your holdings in the fund for the past years? If yes, what have you done?
Right. So, well, I think over the last year or so, this pandemic year, the pandemic or the COVID pandemic has been the overriding theme for the global equity markets. Pretty much everything has been driven by the pandemic, and I think for us the key thing last year was that particularly companies that were losing out from the pandemic or that was suffering during the pandemic became very, very cheap towards the middle of last year, and we were warming up to buy into this type of stocks, and it would have been, you know, things like the banks obviously became, I think, almost as cheap or cheaper than they were during the global financial crisis. In our portfolio, we had stocks like Well-Built, for example, that supplies equipment to commercial kitchens in the US. And of course, when restaurants and so on close down, they don't buy a lot of kitchen equipment, and so the stock got really inexpensive. Similar stories, US Foods, which supplies food to restaurants in the US. Again, a hard hit during the pandemic, but also very, very strong recoveries as we come out of the pandemic. And for us, we took the opportunity to buy into some of these stories. I would say one example, I have a slide on here, is the banks in general. We don't particularly like the banks. We tend to be underweight banks because we think banks are very low moat, low tailwind type of businesses, right? Not very many sustainable competitive advantages, very tough competition, and headwinds from falling interest rates and increasing regulation and so on. So banks have a really, really tough time doing business. But like I said, during the pandemic, investors got really, really nervous about the banks and what would happen to their balance sheet and what would happen to their earnings power. And on top of that, the regulator didn't allow banks to distribute capital, pay dividends, and buy back shares, which is, of course, another unattractive features for investors. So when we started to sort of see the end of the pandemic and there was talks of the vaccines coming through, we figured that it would be a good idea to actually go overweight the banks for once, and so this is one typical thing that we did during the pandemic. If we look forward, I mean, where do we want to be placed now, or how do we see things playing out? We still like the banks. We're almost always overweight IT, tech. We think that is going to continue to perform really well because the pandemic has really emphasized or accelerated some trends in digitalizing processes across almost any industry. Us being on this call, for example, is one example, right? So tech is clearly a structural winner with a lot of tailwind. And to highlight a first thing, I would say healthcare sector, pharma is quite interesting at this point. Pharma has become really, really cheap. Multiples are very low. We think there are a lot of hidden reopening stories also in pharma, and they are defensive. So if you're worried about, you know, the economy overheating or something like that, pharma is a good place to be. I can give you an example, right? Merck, for example, is a US pharma company that has a big oncology franchise. And during this pandemic, one of the sort of horrible, if you will, side effects has been that people have not gotten their diseases diagnosed, and cancer is one of them. So you've seen cancer diagnosis go down, cancer treatments go down, and we think that's going to turn around in a big way going into this year. And the same thing is going on with them with their vaccine franchise, where when people are taking their COVID vaccines, they maybe worry about, you know, combining vaccines and so on, and that's also going to change. So Merck is a stock that we have been investing in recently, for example.
Okay. So a big thank you to Johan for being here today and for such a lovely discussion, and appreciate your patience We had some technical problems, and I appreciate that you're being here. And hopefully our audience will leave better informed and potentially feel excited about the opportunities from the best-in-class global companies in your strategy. Thanks again, Johan.
No, thank you.
I hope you all enjoyed today's Portfolio Manager Conference and have a wonderful day, and see you next time.